Hey everyone, welcome back to the channel. Ben Morales here and happy to be with you today and want to ask a question. Have you ever been to a restaurant and left a 90% tip? Probably not. What have you ever been to a restaurant and left a 70% tip? Or have you ever tipped anyone for some service that they've done for you 70, 80, 90%? Probably not the norm. Maybe once in a blue moon, you might have a extreme aha moment and be willing to do that. But for the most part, it's not something that we do. We don't go to restaurants and tip that high. We don't receive a service and leave someone a tip that high. Usually it's going to be around 10 to 50%. So that's the norm, right? We're used to not giving that type of tip simply because it's something that is the norm. Did you know that there's another norm, though, that really impacts you when you get a mortgage? And the banks don't talk about this at all. It's on the paperwork of your mortgage when you close the loan, but you probably breezed right through it and you really didn't even realize what it was, the cost of that mortgage that you got. I want to talk about the whys, why this is important for this family, because the sooner they are able to pay off this mortgage, the sooner they can start to put money aside for their children and fund their children's college education and pay off their student loans and start doing other things for their family. This is a young family, and now is the time to get this done. So basically, they've been in a mortgage now for 3.5 years. And that mortgage that they've been at, their interest rate is 4.75. So on paper, right, we look at the interest rates today and we say, wow, their 30-year rates are at 6.5, 6.75. Maybe like a 15-year rate is probably like at a 6 or a high 5. And we only focus on the interest rate. We only focus on what that payment is going to be on that interest rate. We don't focus on the back end on like what's the true cost of that particular loan. We don't focus on the fact that that loan is coming front loaded and all the interest is being paid upfront to the bank. So when we look at even this particular scenario here, even with a 4.75 interest rate, we can see from the last video we did, this is their breakdown of their mortgage payment. So their principal interest, $983.97. That's going to principal and interest, but this is the amount that's going to the principal, $255.87. You're not going to make a lot of ground like that. The other amount, $683, is actually what's going toward the interest rate. So we can see why that in 3.5 years that they have the home now, they've only paid $7,190 toward the principal. Again, that is by design. One of the big reasons is why, because of the extra costs that are involved when you get a mortgage. So let's look at this. This is the breakdown, and this is what they only want us to focus on. The loan is 4.75 interest, right? They get the loan is $180,000 going into it. So now they know, okay, we're going to have the next 30 years to pay off the $130,000. What they don't tell you is that, okay, in the span of 30 years, and we know that, and studies have shown that very few people stay in a mortgage for that long, but they paint the picture as a 30-year loan payment. If you were to follow the payment schedule, that's what this loan is, an amortized schedule. You'd be making $338,000, 338,027 and 47 cents. That's the total amount of payments, of which 158,000 is total that's in interest. So that's $158. If we look at 158,000 and 180, you're almost paying for that home twice, right? You're almost paying for the home, the cost of the home twice. And we know that in that 30 years, there's going to be a lot of things that are going to happen. Most of people will refinance and start the process all over again with the upfront costs. How are you ever going to get ahead in your finances when so much interest is being paid throughout the course of 30 years, when what's really impacting that is because they only want you to focus on the 4.75 that is showing up on your mortgage clause. But what's really happening, there is a bigger number, and that bigger number is known as total interest percentage. That's right. It's a tip. Now, I don't know about you, but I've never been to a restaurant where the food was so good that I left a 90% tip or 100% tip or 110% tip. And yet, when it comes to mortgages, that's exactly what we do every time we do this type of transaction and have this type of loan set up. So how do we figure out what is the tip that we're giving the bank? And it's kind of frustrating or irritating or enraging rather when you find out what the true cost and what the true interest cost is, or the true interest percentage is for even a loan with supposedly such a low interest rate. So what we do is you can take the amount of interest that was paid, okay, and you divide that by the original loan amount. When you do that, you are going to get a number, right? And by the way, this information is on every single loan. If you bought a home recently, go to your closing disclosures and you're going to see in your closing disclosures, going to give you all these numbers. It's going to show you your interest rate expressed as an annual percentage rate. And then it's going to say somewhere along the lines, this is not your interest rate. It's going to calculate the interest cost over the life of the 30 years. And then you are going to get a big, huge number that says that this is your total interest percentage. In this case, when we do this math, we're going to get 87.79, or you could basically round it off and look at the actual interest rate. This is the actual interest percentage of the cost of this loan over the last years. That's an 88% tip. So imagine, again, I've never been to any restaurant where the food has been so excellent that I've left an 88% tip. Most cases, probably you haven't either. But yeah, we do this every single time that we get a mortgage. So I wanted to bring awareness to you because now you know the truth behind interest rates. It's not this, right? Don't go by this. It's actually more along the lines as this. So when the bank is coming out and making this much money off of the mortgage, how is it that you're ever going to get ahead and pay off that mortgage? Chances are you're not. And that's why in 4, 5, 6, 7 years, you're doing a refinance to get the lower rate, and the process starts all over again. So again, in this channel, we teach the velocity banking. That is the strategy that you want to implement. We showed that in the last video with this family, how they're actually going to leverage that and use it for their benefit. I hope this video brings some clarity to you exactly what the costs are behind when you get a mortgage, and start empowering yourself via home equity line of credit. Start to put the credit pieces that you need in place. So just like this family, they can speed up the process, and you can speed up the process of paying off your debt a lot sooner. So until the next video, thank you for tuning in today. Don't forget to like, subscribe, and share, and we'll see you soon.